Hey everybody, John King. Thank you for joining me for my Financial Friday weekly live stream. As you know, we come to you every single week at noon with whatever information I feel like talking about, and really trying to provide you good information to grow your financial life, whether it be things that have to do with mortgage, like today's topic, or things that have nothing to do with mortgage, like we've talked about banking, we've talked about how to go buy a car. If you have questions about any of that kind of stuff, check out my library of Financial Fridays that I've done. I'm going on almost a year of doing my Financial Friday live streams. And if you have an idea of a topic that you want me to cover in the future, feel free to bring that up. Today, I am super excited that I have a special guest. So let's bring in my special guest. So this is Josh Gibson. So great. My banner says Josh Gibson right underneath me. Here, hold on. I can fix that. So let's move my special guest right there. Now it says
you can be Josh Gibson.
I could be Josh Gibson, but then we'd have to call this the Josh Gibson Show. And, you know,
you've done well. No point in starting over.
Josh Lone King, just, I don't know. It doesn't have a ring to it.
No.
Anyway, Josh, welcome. Josh, tell us who you are. What do you do? Why in the world would I want to bring you on a show like this?
I have no idea. No, thanks for having me on, John. So I am our Director of Capital Markets and Product Development for Summit Funding. So I wear a few different hats for Summit Funding. Half of the time I'm working with our capital markets group, managing the loans that we hedge and trade and deliver to the agencies, Fannie, Freddie, Ginnie Mae. The other side is the real fun and creative side, which is getting to interact with all of our potential investors, as well as our loan officers and our branches, and really trying to find products that are going to serve a need, fill a niche for our branches, and really support the borrowers that our loan officers serve each and every day.
I love it. Josh works in a department that doesn't speak English. And he is the best versed in English of anybody that I know that works in his department. But he threw out some great words like capital markets and hedging and stuff that the normal person has no clue what any of that means. Let me tell you in a nutshell what Josh does. He finds us the money. That's it. So Josh really is the intermediary between where I'm helping you get the mortgage and Josh is saying, okay, but how much is it going to cost? Like, how do we price that loan? Price meaning what interest rate and fee are we going to charge today? Because here's the crazy thing about the mortgage industry is Josh has to tell me what rate to offer you, even though he's not actually selling that loan to somebody for a month and a half to 2 months. Is that about right, Josh?
It's spot on, and it's very, very tricky sometimes. These markets have been even trickier than usual.
Yeah, he's got to predict the future and basically say, hey, I'm going to set an interest rate that I think I can make money and not lose money, while at the same time delivering the best possible deal to our clients, but I'm actually not selling it for 2 months. And the buyer that wants to buy that mortgage in 2 months, the landscape's going to be different. And the market interest rates are going to be different. And so it's a very tricky job. And you're required to speak multiple languages. English is really low on the list. So I help translate and kind of make that a little bit easier. The reason I brought Josh in, first of all, I like him. He's a funny guy. He also has good taste in shirts because I think we're close to matching with a
got the memo,
shirt. Is it blue? Is it teal? Is it? I don't know.
It's blue.
It's blue. Okay.
It's my power color.
Anyway, yes. So Josh is here really as a subject matter expert in what we're going to talk about. And really what we're going to talk about today is we're going to talk about manufactured home construction loans. And this topic is really confusing. It's something that people want to talk about. They think, oh my gosh, that'd be great. If I could buy a piece of land, Josh, and I could just plop a manufactured home on it, I could buy something for pennies on the dollar. And by the way, I'm being facetious here because it's rarely pennies on the dollar. I'm going to let the cat out of the bag. Josh told me when I asked him to join me, he goes, John, I don't know if you want me because these loans are hard and these are never easy for people. And I'm not sure I'm going to give the sales side of things. And I said, don't worry, Josh, I don't want sales. I want education. So the truth is people think the idea of I'm going to buy a piece of land and I'm going to stick a manufactured home on it. And instead of paying $400,000 for a 1,500 square foot stick built home, I'm going to get something really, really cheap by just buying some land and throwing something on there. And the fact is, it often isn't that much cheaper when you get down to the end. And it is a lot of work. Would you agree with that, Josh?
Yes, I think in most of the transactions, if you're someone who has a bunch of cash and has the ability of buying the land cash and buying the manufactured home cash and paying a contractor cash, that can actually be a fairly simple, with all of those moving pieces involved, process. Most people need traditional financing, might have limited down payment funds to put towards a transaction like that. That then brings a lot of additional layers onto it that need to be built into what can be a fairly traditional mortgage transaction. These can get pretty complicated.
Yeah. So Josh is our expert, and I'm going to start high level and we're going to dive in. But what we're going to cover is really everything from soup to nuts. By the time you're done, we'll be done here in about 20 minutes. You will have a good idea of how this works. And more importantly, you'll be able to decide, is this something I want to take on? Because I'm ready to take it on with you, but it's not going to be easy. As a matter of fact, I had a realtor tell me a long time ago that he was taught by his mentor that success as a realtor is completing the transaction before your client hates you. I think that's got a pretty good merit to it.
Yeah.
Here's the deal. Good. These loans take 6 to 12 months. By the time we get to 6 to 12 months, you're going to hate us. And I don't mean that in any other way than there are going to be challenges. There's going to be issues. And unlike a normal escrow that takes 30 days, and by the way, we can close escrow in 30 days, maybe 45. But there's other pieces to this. There's the construction part of the process we're going to get into. And that's where I really want to educate you on, hey, is this a good idea for me to embark upon or not? So that's really what we're going to focus on today. Now, the first topic I want to talk about is why build versus resale? And I say that because there's a lot of people who just have this dream of, I want to build a home. I want it to be mine. I want to get it my way. And I think that dream is noble, but the truth is there's lots of different ways to go about getting a newly built home. One of the simplest ways is to just go to your local subdivision who's got a company that's building these homes and they're ready to get one built for you in the next 6 months. And you got a beautifully built home by a company that does this on a regular basis. And I'm talking about a traditional stick built home. And that's one way to do it. And you're not financing the construction. The seller is. That's super simple. You're just buying a finished home. You just have to wait until the home is finished to actually buy it. So that's one way that you can get a brand new home. A second way is you can say, hey, I want a brand new home, but I want to be the part of the process. I want to buy the land and get an architect and spec it out and do all that work and get a construction loan. And that is a whole different level of complication. It's actually, I think, a couple layers beyond what we're doing with this manufactured home loan.
Definitely is.
It's why we don't do a traditional stick-built construction loan, because that process is even more cumbersome. And the last thing I want to do is to try and be something to you that I can't deliver and try and be, everything to everybody. There's a lot of local banks that are very well poised to take great care of the construction loans. There's a couple of national banks that are very well poised to take care of the construction loans. But what we're finding here is a niche with the manufactured homes that we'll get into in a couple of minutes. But I got to tell you, as much as there are great things about buying brand new, whether you build it yourself or you buy it that somebody else built, there's some negatives. You don't get any not floor coverings. You don't get any window coverings. You don't get the backyard being done. The simple things that you take for granted in buying a home, they don't exist when you're buying something brand new, whether it's in a subdivision or whether you're having it built. So just be aware of that when you think about the difference between, gosh, should I buy something brand new or should I buy something resale? Now, Josh, I want your help with this a little bit. We talked somewhat about stick built. I want to get a better understanding of the industry definition of mobile manufactured prefab, because I hear those words thrown around all the time. And I don't think many people understand, do they mean the same thing or do they not? And then I want to talk a little bit about tiny homes. So can you help me with defining mobile manufactured prefab and then dive into the new niche?
So stick built is what most people are going to find when you drive into any given neighborhood, or you have, say, Lennar Homes or someone like that is building homes. Those are stick built. They bring a bunch of sticks out to the lot. They put those sticks together, and a home comes from that. There's prefab, which means that the sticks are 50 to 75% put together in a warehouse somewhere. They're put on a truck. They're brought out to a site in, walls and trusses and things of that nature. They're put up there. The exterior is put on the home. That is a prefab loan. And oftentimes those are going to be financed and underwritten in the credit world, very similar to a stick-built home. Okay. It's when you become a manufactured home that you cross over a line that now needs to be clearly defined and is treated from a collateral standpoint and a credit underwriting standpoint a little bit differently. So a manufactured home is a home that is built in 1, 2, or 3 pieces in a warehouse and is completely finished outside of, if it's a two unit or 3-piece home, when it's being actually put together. So outside of it actually being put together, put on a piece of home, it is completely finished in a warehouse from one of the manufactured factories doing the manufactured home. So that's where you kind of see the little bit of a difference.
So when you talk about 1, 2, or 3 units, what we're talking about is big Legos, like a big piece of a home. And you hear the terms single wide, double wide.
Thank you. That's actually the term I was looking for. Using the term unit can be a little bit confusing with duplexes or triplexes in that case. So yes, thank you, John.
And am I overthinking this or underthinking it? Like a single wide, double wide, the wide is how wide a lane is on the highway, because you got to drive this thing from the facility to the location you're going to plant it. So a double wide is kind of the width of 2 highway lanes, and a triple wide is 3 of them, because you have to slice it small enough to fit down the road. Is that why they call it?
It does end up being delivered on a trailer that is, a semi-tractor trailer is driving that down the road, oftentimes with a big wide load flag on the back of it and somebody behind them and in front of them. But yes.
Okay. So really now when you say it's completed, like, are the cabinets already built into it when they leave the home, leave the shop, and they're literally just, hey, we're just gluing these 2 together side by side?
Oftentimes all the way down to that detail. It might have plumbing fixtures and cabinet handles and things of that nature, but they assemble it in the factory. They strap everything down so it can be in a good condition as it makes its way down the highway. But yes, it is 99% completed when it leaves that factory.
Beautiful. I want to jump into a question really quick. By the way, I always encourage questions. You also get to see your name and lights right here if you ask a question. So Kathy said, these homes are often put on or can be put on acreage. Josh, I have some thoughts on that. Do you want to address that real quick?
So the answer is yes. And oftentimes that's the borrower that is oftentimes looking at a manufactured home. Oftentimes it's somebody who wants to live in a more rural environment. You're not putting a manufactured home in a traditional residential neighborhood. Oftentimes counties and cities will have zoning limitations that don't allow you to do that. So yes, there is acreage allowable. There are, depending on the loan financing program that you're going to be utilizing, there may or may not be limitations on how much acreage you can have, the value of that land in relation to the value of the home that you're going to have on the land, things like that come into play.
So Josh, the other thing, and this is a question that we're going to get to kind of guidelines, but I think it brings it up, which is, well, what if I have a main house and I want to have an ADU? I want to have a second house on my land. I can imagine, and we see it regularly, where somebody puts a manufactured home as a second home on the land. Is that something that we would finance through this program, or is that something that have to use different financing for?
The particular program that we're talking about today, as Summit Funding offers it, would not be an eligible program. Our program is designed for the principal residence, a single unit on a single piece of property.
Beautiful. All right, that's what I thought, but that's why I have you here as the expert. So that's mobile. We talked about prefab. We talked about, now, did you just talk about manufactured or mobile, or
let's consider what I just described as manufactured.
Okay. So what's mobile?
So mobile in most cases is a single wide that's never been permanently affixed to a foundation at the property that it is
Planted.
residing at.
Yeah.
It oftentimes has the wheels still attached, and someone could either put that onto a trailer or hook it up to a tow vehicle and on a hitch and roll that right on down the highway to its next destination.
But we can convert a mobile into a permanent home by taking off the wheels, attaching it permanently to a foundation, and then in California specifically, you file with the HCD, the Housing Community Development Department, to get what's called a 433A, and that's the document that says, hey, this is no longer registered with the DMV. This is registered with the county as real estate, and that's when we can actually do a loan. Now, again, what we're talking about here is the construction loan to make it into that real estate. But when you normally hear about mortgages on manufactured homes, that's what we're looking for. If it had wheels when it was born, are they removed? Is it permanently on a foundation? And is it no longer registered with the DMV, but instead registered with the county via the Housing and Community Development Department?
Correct. Yeah. What that's doing is that's taking it from personal property to real property or real estate, which is required to be used for collateral in any type of a real estate financing. Now, one note to clarify is that our program is designed for new construction. So we would, in our particular program, would require the unit to be a new build coming out of the factory from a particular manufactured housing retailer and builder. Now, that doesn't mean that we don't have possible solutions for what you described, John, which would be something that was existing, had wheels on it at one point in time, and is now being placed as a permanent residence on a property.
Perfect. All right. So we got about 15 minutes left here, 13 minutes left here. So I want to quickly touch on tiny homes. Can I do tiny homes with this type of lending?
Not this program, no.
Okay. So
there are options for financing of tiny homes. But this particular program we're talking about would not treat a tiny home as a manufactured home. Okay.
So here's what's most important about this program, that we're using traditional, conventional FHA. We can do VA on this one or just
Yep.
Yeah. So FHA, VA, Fannie Mae, Freddie Mac, we're doing conventional financing. That's the difference. With a lot of these other construction loans, you've got to put down, 20% out of your pocket on the construction financing. Now, once you're done building the home, then you do what's called the takeout loan. So there's normally what's called a two-step construction process. You go to a bank, you get your construction loan. That's the bank that is loaning you the money. That's kind of like a line of credit. And you get draws that they write a check to buy the land. Then they write a check, and I'm talking about whether it's manufactured or stick built. They're writing checks along the way to pay for all of those stages. So that's really how construction loans work. Is the first part of the loan is the money that you're getting to build the property. Once the property is completed and we have a certificate of occupancy, then you get your permanent financing. That's often called your takeout loan. The challenge is that when you look at the approval process, you have to go through it twice. You have to go through it once when you're getting the construction loan, typically with the construction lender, and then a second time when you're doing the takeout loan. And so there's there's an evolution called the one-time close construction loan. And that's what we're offering, is in conjunction with traditional Fannie Mae convention or FHA and VA guidelines, we're doing it all as a single transaction. Josh is going to wave his hand and yell at me if I say anything wrong here. That's why I've got him here. So we're doing this all as one approval process. So it's called a one-time close, but it's still two separate loans. You're still getting a construction loan. We're just handling the construction portion, and you've got a separate interest rate. Right now, I think we're tickling 10%. I think 9-something%.
999. Yep.
For the construction, but you're only paying interest on the portion that you've drawn, the portion as you need it, kind of like a line of credit or kind of like your credit card. But the cool thing is, in a lot of cases, we can include the cost of that interest in the cost of construction, because most people can't afford to pay for the place they're living and the place they're building at the same time. So if we're qualifying you, we're saying, hey, you can afford to live in this new place when you move into it because you're not going to have rent anymore. But while the place is being constructed, you have to still pay rent. So we don't have the expectation you're going to have a whole bunch of extra cash to pay for that monthly payment. We can build that into the cost of construction. This is very, very different. By the way, I want to make sure I'm covering any questions. Kathy loves tiny homes. Kathy, I know you're going to talk about, I'm going to talk about septic and water well drilling in a couple of minutes. So we'll cover that. How is this different than a rehab loan? There are rehab loans that once a home has a certificate of occupancy, then I can do a loan that basically on a stick-built standard home that can renovate that loan. It could be a burned down home. It could be a tear down, as long as it's got a certificate of occupancy and there's some rules on how much of the foundation we're changing and that kind of thing. But the fact is that's a renovation loan. Very different than a construction loan. So I do want to point that part out. We talked about down payment can be as little as 3 to 5% down. Am I accurate on that, Josh?
That is correct. Now, I will say that guidelines like these are ever changing. So definitely stay in touch with John as if you do have interest, because he'll give you the most current up-to-date notes on that.
Beautiful. So Josh, how long does this take from start to finish? I mean, if I identify a piece of land today and I've got pre-approved from an amazing lender like myself, when can I move into the house?
So oftentimes what you'll do is you'll go through about a 30 to 45 day period of time where you're doing traditional underwriting, building out all of the construction financing. Borrower's going to come in and close and basically sign for that mortgage. What happens after that closing is now all of our construction and everything begins to move forward. So the timeline often has to do with how much of the work has been done on the site already. So if somebody already has septic and well and electric at the site, and we're just dropping a manufactured home on, putting a foundation, affixing it to the foundation, oftentimes that can be a 60-day time frame from the time that we close to the time that we're getting that certificate of occupancy. If we're starting from a bare piece of land and there may be delays with getting contractors and things like that, we've seen that go as long as 6 to 12 months. Optimal for this particular program, as we've built it, is a 4 to 6 month window from the time that we close to the time that we have our certificate of occupancy.
Beautiful. Okay. So what we're including in the loan amount, and Kathy had asked this question and she said, hey, can we do well and septic? The answer is yes. So I simplify this by saying there's 4 things that we include. We include the purchase price of the land. We include the cost to prepare the land. We include the purchase of the manufactured home, and then the cost to install the manufactured home. So when you think about those 4 things, that really is everything. Now, sometimes you already own the land, and so we don't need to include the purchase price of the land. Josh, can we include that the cost of the land, or the value of the land in the equity calculation, or no, if they already own it?
When we're doing what's called a maximum mortgage worksheet, and that's something that you'll work with these borrowers on, John, you will outline the maximum eligibility for their particular mortgage. If they do own the land already, the market value of that land can be included in that, which adds a lot to what ultimately you can finance into it, because they come into the transaction with that equity.
Got it. Beautiful. Okay. So really simple. That's what we're looking at, is those are the 4 things. That includes the cost of building out the land itself, getting it prepared with well and septic. I'll tell you that the biggest tip that Josh gave me is try and get a manufacturer that will include all of those services, so that the manufacturer of the home is also serving as your general contractor. Your life will be way easier if we're dealing with a single point of contact. If you're trying to coordinate all of this and have, hey, I'm gonna be my own general contractor, and I'm gonna get the septic guy out here, and I'm gonna get the well guy out here, and I'll coordinate the other guy to come and put it on the foundation, it's gonna be a nightmare. And we're going to run, you're going to hate us. You're going to hate everybody that's working on the transaction. It's not going to work out well. And the manufacturers I've talked to encourage that, and they want to do that because they can make this a more seamless transaction for you. Did I get that right, Josh?
You nailed it. I'll just add, oftentimes on the surface in the beginning, it will seem as though there may be some cost savings to try and do some of this on your own and maybe not lean on a retailer builder that's going to facilitate all of this in one clean purchase price for you, that's got all of these site improvements and everything built into it. What we have seen in almost every single transaction where the borrowers have tried to be a little more frugal on the front end and structure it this way, they have cost themselves in overrun costs, and they have cost themselves in a lot of extension fees to get the project completed. So you will save yourself a big headache and a lot of money by finding a retailer that's going to act as your general contractor and just facilitate all of this in one clean purchase price for you.
Got it. So we answered the question about, do I need a contractor? You do, but you really should have the retailer, the person who's selling you the home. It is best to have them be your contractor through the process.
We do have to vet every contractor that works on the project. However, if it's going through one general contractor like our retailer, we just vet our retailer and make sure that they're verifying the licensing of everyone that's going to work underneath them. So another headache that can be saved by going down that path.
So how do I pick a home? Do I just Google any mobile home manufacturer? Are there rules on who we can use as a manufacturer? And part of that question is, do you have any feel on turn times? Because we just went through, the pandemic where you couldn't get products and builders couldn't get garage doors. So how does that impact this industry?
So, there's some big names in the industry, and I won't drop any of them on this one right now, but there's 3, maybe 4 really big names that you can work with. There are also retailers that work with those 3 to 4 really big manufacturers. So there's a couple different ways you can do it. You can work with Josh's Manufactured Housing, and I would be a representative of all 4 of those builders, and you would come into my showroom and we would talk about which of those is going to be best, or you can go to just one of them and work directly with them. In either case, we're going to require the approval of whomever that you're working with, just to make sure that they are truly financially stable enough to manage a transaction like this.
Love it. So Josh, this is right in your wheelhouse about your other job of managing capital markets and risk and hedging and all those cool words you used at the beginning of the call. So this is a question I get a lot, when do I lock an interest rate? Well, ideally, we're locking it in the beginning when we're approving we're locking your loan in the beginning when you're approving your loan, but it is a long-term rate lock because We're actually not selling the loan to Fannie Mae and to Wall Street until the home's finished. So we have to extend the rate guarantee, and that's expensive. And I'm not going to let Josh explain any of that because it goes over my head when he explains it. And I've been doing this for 23 years. But really simply what we're doing is we're trying to buy an insurance policy against rates going up that covers us for that 6-month timeline. That's the simplest way to say it. And guess what? You as the buyer get to pay that insurance policy. You pay it through a little bit higher interest rate or a little bit higher fee. This is not anything specific to the construction loan or specific to Summit Funding. It's just what's called hedging our lock. But the longer we have to guarantee that that's the rate we're going to give you, the more risk there is and the more it costs for that insurance policy. Is that a good way to put it, Josh?
Spot on.
Beautiful. All right. So the last thing I really want to talk about is do I need a pre-approval and how does the process work? Yes, you need a pre-approval. This is very much just like buying any home. You need to pick a great lender. I know one. I sleep with him every night. So if you need a recommendation, call me. I'll recommend a great guy. The fact is, you're still going to have to qualify based on your cash, how much money you have for down payment and closing costs, your credit, how well you've paid your bills in the past, and your income, how much money you have to pay the bills in the future. We're going to go through the normal qualification process. Once you're pre-approved, that's when you write an offer on a home. And then once you've written that offer on a home, we're actually writing the offer on land. Josh has to go, by the way, right at 12:30. So if he disappears, that's why. So once you get the pre-approval, you write an offer on the land. We close escrow on the land in 45 days. Sometimes sooner. I'd say 45 days is a fair escrow period. And that's when During that 45-day process, we're confirming the dollar amounts with the construction, the builder, making sure how much the manufactured home is going to cost, and get all of your selections picked so that really we can start the order process and the site preparation as soon as you become the homeowner or the landowner, and we start writing checks on your behalf to pay for the things that need to get done. Any parting thoughts?
I do have to jump, but there's a couple things I wanted to throw in here before I run, John. So a second ago, you were talking about the timeline to get the manufactured homes out of the factories where they're built. So during COVID, when our supply chains had broken down drastically, that was as long as 24 months. We're closer to 6 to 18, depending. I know that's a wide range now, but it all kind of depends on what models you're looking at and who you're working with. What I can tell you is that we cannot close our loan until we have a delivery date for that manufactured home to be delivered to your site. So it is incumbent to really keep track of that timing, because if you're looking to buy a piece of land and we can't close until that manufactured home comes out of the factory, and it's not going to be out of the factory for 12 months, you may have to work with the seller of the land that you're on for a long close of escrow on the contract that you're writing there. So an item to keep in mind.
I know you have to go, but do you have 10 seconds for me to ask a clarifying question?
Yep.
So I can't close until I know what the date is, or until that date is here?
Until we are within a reasonable period, depending on all of the other nuances. Typically, we say about 10 days.
Of the home leaving the manufacturing plant. So you can't buy the land and close escrow on the purchase of the land until the manufactured home has rolled off the assembly line.
Yep, until we've got a date scheduled. Typically, they give about a 2-week window that they're going to be able to deliver that in. So okay. that is a really important piece of kind of stacking the dominoes to all fall in line. The other thing I'll tell you that's so important about a pre-approval on that topic as well, John, is there's just a lot of moving pieces in how you're going to calculate what you can be approved for. So I would encourage you to spend the time with John and work through the nuances of, what equity are you bringing into that transaction with the land that you might own, and what are the site improvements going to cost, and those types of things, so that you can really accurately come up with a pre-approval. Because when you go into the retailer and start shopping for a home, they're going to start asking you how much you can afford, and this is going to be the way that you're going to be able to give them a good answer on that.
Love it. Josh, I appreciate it. We're going to let you go.
My pleasure.
Thank you.
Good luck, everybody.
For joining us. I really appreciate the time that you've spent with us today. I can see my what do you want to call it? My internet's lagging right now. So I'm going to wrap up before it crashes on me. But thank you for joining. This really hopefully has been valuable information. Again, it's a niche product, but I want to really help to always give you ideas and ways to help solve problems. And right now, housing inventory is not that great. And so having a way to purchase a home using, buying land and building a manufactured home may not be significantly less expensive, but it is, and Kathy asked a good question. I'll address it in just a second. It may not be significantly less expensive, but it's inventory. It's a house you can buy, because I'm already seeing multiple offer situations. I'm seeing people run up against, hey, I can't find any homes that suit my needs. So this is a way to solve that challenge. Any questions anybody has, feel free to ask. Kathy asked how real estate agents can benefit from it. So I actually do not know if the retailer will compensate the realtor for bringing you in. I know a couple of realtors that I've talked to about it, and that never came up. Clearly, you are getting paid on the sale of the land. So you're representing the buyer on the sale of the land. I have no idea if you're actually getting compensated on the manufactured home piece or not. That is a good question, and I hate to say I don't have a good answer. Anybody else has any questions? Feel free to post them into comments. I'll follow up and get those questions answered for you later. Hope everybody has an absolutely wonderful weekend, and we'll talk to y'all soon. Bye-bye.